Good morning from London. I'm Kriti Gupta alongside Valerie, Tytel. We're an hour away from the opening trade. Here's what you need to know. Stocks sell off around the world as investor worries around valuations and leverage continue to grow. Bitcoin trading below $90,000. Is it a pullback or a pop? Meanwhile, geopolitical news, Japan is mounting a broad diplomatic effort to ease tensions with China after Prime Minister Sanae Takaichi's comments on Taiwan sparked sharp backlash from Beijing and raised fears of a breakdown in economic ties. And President Donald Trump hosts Saudi Crown Prince Mohammed bin Salman at the White House today. Energy and defense on the agenda, Val.
It's looking like we are tracking Wall Street's losses on Monday are turning into Tuesday being also in the red on a global scale. The MSCI Asia Pacific down 2.3%. Some surprising weakness out in Japan. The Nikkei down over 3% on the session. S&P futures are now headed for their fourth day of losses, down 0.8%. And Euro Stoxx 50 futures playing some catch up to that weak close on Wall Street, down 1.5%. The countdown to the opening trade starts right now.
Happy Tuesday. Lots going on in the world. We left here 24 hours ago and things seemed kind of quiet. Man, did we really brace ourselves for a massive sell-off. And Val, we're seeing that this morning around the world. About a 1% drop in the S&P 500 in the U.S. session, but really magnified in the Asia session, down almost 3%. You showed us in the futures picture, Europe isn't going to be able to escape either.
Yeah, Europe in the red as well. And it was funny that this was all really kicked off by Amazon's announcement of a bond offering. They raised $15 billion in debt, mostly to fuel their AI ambitions. And this is now the fourth large AI hyperscaler to tap these debt markets. And essentially, when you have this backdrop of a hawkish Federal Reserve, of members not wanting to declare that that Fed cut in December is really on the cards, you're getting this kind of reaction in the equity market. This AI trade is so dependent now on this debt-fueled boom, and it seems like liquidity is tight, and that is causing some ripples in the Nasdaq.
It's fascinating here that we're talking this about every time a hyperscaler, and traditionally Apple gets this rep, that when they come to market, they are lauded for timing the market. It's this massive tell that everyone else should probably be piling into the market as well. And you saw that with some of the other issuances and offerings that came to market yesterday as well. I think what's fascinating is just how jittery, to your point, everyone really is on this leverage piece. What we're not seeing, though, yet is that relationship or that stronger correlation between the stock market and the bond market show up yet. That is still kind of operating on two separate pages. And I think it's really fascinating. We're going to have several conversations throughout the show about this story because we also have several other pieces of this. The hawkish Fed is one. We're looking at 409 on the 10-year in the meantime.
Yeah, no, this round of debt issuance has kept Treasury yields supported. It did in the session yesterday. Treasuries are really unable to rally on that risk-off move because of this debt issuance. We are seeing a rally today, so the narrative is slightly different. We're down around 5 basis points in the front end when it comes to those policy-sensitive two-year yields. But still, that chance of the chance of a December cut, those chances are still being pared back. In the session yesterday, they sank all the way down to 40%. Kriti, it was only a few weeks ago, back in October, we were nearly 100% done deal that the Fed was going to continue to cut into year end. And we're not necessarily seeing that kind of price action keeping the front end supported at the moment. So without that kind of cushion, this equity slide is continuing. The Nasdaq is now down 6% from all-time highs back in October, and Bitcoin is seeing a big drawdown from its all-time highs back in October as well.
Sub 90,000 on the cryptocurrency. I think what's really crucial here, and I did this very brief chart this morning. If you look at the tick by tick, I was trying to figure out when exactly the sell-off started. You look at the tick by tick of the stock market, overlay it with Bitcoin. It is tick by tick an overlaid chart. They look like the same line. And I think it really speaks to this idea that we're talking then about these correlations not really being synced up, except yet on a tick by tick, second by second basis, they absolutely are. And I think that one's really interesting if we are going to see kind of everything come to 1 or 0.
And I think the 90,000 level for Bitcoin is important. It's been talked about as the average entry point for these ETF holdings, for these retail holdings of ETFs. So perhaps a substantial move below that would cause these retail holders to really start to jump ship when it comes to cryptocurrency. And can we just take a step back and think how odd it is that cryptocurrency is struggling even though we have such a decent regulatory backdrop for cryptocurrencies highlighted by the Trump administration. None of that has really changed, but all of a sudden it's really seeing these jitters on the back of broader worries in tech really seeming to hit cryptocurrency more than anywhere else.
Well, speaking of the Trump administration, he's got a lot on his agenda today. He's hosting Saudi Crown Prince Mohammed bin Salman at the White House. This, of course, follows his trip to Saudi Arabia and other Middle Eastern countries back in May as well. I think it's really crucial. We've hit credit, we've hit the stock market, we've hit cryptocurrency. We haven't hit FX yet, but let's talk about the commodity market for a second, because we know that defense is already on the agenda between these two major players. Mm-hmm. I think oil will be as well. There's some reporting from our peers in the media talking about some of the CEOs that are going to be at the U.S. Saudi summit. A lot of oil CEOs, a lot of tech CEOs showing up at this partnership. But I'm really curious here because, look, the U.S. and Saudi Arabia are the first and second largest exporters of oil around the world. Donald Trump wants oil prices lower. Do we start to see something come out of this conversation on that front?
Well, we've seen that major concession of the U.S. offering these F-35s to Saudi Arabia. Perhaps that major concession is a thank you for Saudi Arabia keeping OPEC Plus on Trump's side to keep oil prices contained. Maybe this is more of a negotiation tactic to try to get out more from Saudi Arabia, who is going to be in the White House today at the Oval Office and also having dinner hosted by Melania Trump as well. So we'll see where these negotiations headed, but it does seem like this key relationship for President Trump, in order to keep his election promise of keeping energy prices low, of returning to affordability, which has been a key point for the Trump administration in the last few weeks, really does hinge on keeping Saudi Arabia and OPEC Plus pumping gas around the world.
And we know this has been a contentious issue when it comes to just how much of the Saudi defense infrastructure the U.S. actually wants to fund. So this is a very fraught political issue domestically in terms of where you are actually putting your partnership. But the friendship seems to be strengthening between Saudi Arabia and the United States, if this meeting is any tell. Let's talk about where this friendship maybe is not strengthening. And that, of course, is in the Asia Pacific. China and Japan not really backing off of some of the backlash that they saw in yesterday's session. We know that those comments from Sanae Takaishi, the Japanese prime minister, of course, incurred some backlash from Beijing. That being said, they're trying to offer an olive branch. I'm not sure it's working just yet.
Yeah, I thought it was interesting that Tokyo had mentioned that they're sending these top diplomats to Beijing, but China, on their side, failed to recognize that even a meeting was taking place. They also threw cold water even over the prospect of China and Japan meeting in South Africa on the sidelines of the G20 this weekend. It goes to show just how much this political rift could widen. I think on the market's mind is, could this get as bad as it did back in 2012? That was when there was a territorial dispute over some islands, uninhabited but rich in resources. It led to a months-long diplomatic stalemate where it saw Japanese exports drop by 10% as China balked on buying Japanese goods. Now, Takaichi, the new prime minister there in Japan, has really bent her whole campaign on returning Japan to growth. Now, this could be something that could really disrupt her economic mission. And remember, Trump was just in Japan, Kriti. He essentially stood next to Takaichi and said, anything you want, I'll give it to you. Is the U.S. going to get dragged into this diplomatic furor over Taiwan? Because that could be something that could really disrupt the appeasement of these trade ties between the U.S. and China from that breakthrough just a few weeks ago.
Yeah, we should mention that you've already seen some really harsh commentary coming out of Beijing, China accusing Takaichi of reviving Japan's, quote, militarist demon, saying that's going back to becoming a defense-first state, which, of course, we know she is a major hawk of. We should also mention to our global audience, we are seeing the Chinese Foreign Ministry having a briefing at the moment. So if there are any headlines that come out of it, we will, of course, bring that to your attention. These are three stories that we're going to be continuing to monitor in the hours ahead. Let's tell you what we've got coming up on the show ahead. A really all-star lineup this morning. Haig Bathgate from Callanish Capital, the CEO there, will be making an appearance, usually based in Dubai. We're thrilled to get his take on some of these moves that we are seeing in the markets. Plus, how does the public markets show up in the private sphere, especially where that's where so much of the investment growth is happening? Frederick Stevenen, PAI Partners co-managing partner, will be joining the show as well. Plus, an all-time favorite, Kevin Gordon, Charles Schwab's macro research and strategy head, also joining. We're going to get these various takes, the equity take, the cross-asset take, of course, the private credit take on just kind of what valuations and these concerns mean for the economy.
And let's bring you up to speed with the risk events on the horizon today. We do have some earnings to contend with over in the U.S. Home Depot is kicking off a busy week of retail earnings. They will be reporting before the bell. Then at 1:30 p.m. UK time, we do get the new weekly ADP employment data numbers. Remember that those came in surprisingly weak last week, did trigger a bond rally and a further stock sell-off. Later, we'll also be on top of the Saudi Arabia visit to Trump in D.C. Mohammed bin Salman meeting in the Oval Office with the Trump administration, and also sitting down to dinner with Trump later in the hour. So we'll be watching those headlines as the day rolls on. Another major event today, though, that we have our tabs on is Bloomberg's Africa Business Summit in Johannesburg, where global leaders are gathering to address the critical issues shaping Africa's future and drive forward the global economy. Our own Lizzie Burden is on the ground there in South Africa. Lizzie, what are the highlights so far?
Well, good morning from Johannesburg, Val. We've got the leaders of investment and policy making on the continent here at the Bloomberg Africa Business Summit. Of course, this is ahead of the G20 and B20. South Africa has the presidency right now, and it is such an important moment for Africa. Of course, we're in the AI boom. It's powered by young people, and Africa has the fastest growing and youngest population in the world. It's also, of course, powered by rare earths, and they're not in short supply here either. So I'm going to be speaking to some of the biggest names in the investment space here. We've got Jonathan Oppenheimer, whose family, of course, built Anglo-American and De Beers into the global mining powerhouses that they are. We're also going to be speaking to Hendrik du Toit, the CEO of 91, South Africa's biggest fund manager. And on that AI race, I'm going to be speaking to Alex Okosi, who's the managing director for Google here in Africa. Really interesting to get his take on Google's strategy on the continent, given the AI race in Africa between the US and China, and many would say that actually it's China that's winning that right now. The event's already kicked off for the day, and terminal users can follow along, Val, by going to Live Go on the terminal.
That was Bloomberg's Lizzie Burden on the ground in Johannesburg. We'll be hearing from some of the business and political leaders at the Bloomberg African Business Summit later today, including Leila, Fourie, the CEO of the Johannesburg Stock Exchange, that bringing to you in the next hour. Also, Patrice Motsepe, the founder and chairman of African Rainbow Minerals. And finally, Daniel Pinto, the vice chairman of JPMorgan, will be sitting down for some panels with our team. You are seeing a live image now from a fireside chat with the South African Minister of International Relations and Cooperation and Bloomberg's Deputy Editor-in-Chief, Reto Gregari. You can catch the whole conversation live on your terminal. Just go to LIV Go on your terminal.
Lots going on there, lots of interesting conversations we're, of course, going to bring you right here on Bloomberg Television. Looking forward to those conversations. Our very own Lizzie Burden, Jennifer Sabasaja, and several others are, of course, on the ground there. Let's talk about what else we need to know when it comes to some of the news this morning. In a bid to bolster the fragile truce between Israel and Hamas, the United Nations Security Council has endorsed President Donald Trump's Gaza peace plan. The U.S.-led 20-point deal was approved with 13 votes in favor, despite Russia and China abstaining. Washington insists UN support for the deal will help lock in momentum and strengthen efforts to deploy international monitors. And multiple subsea internet cables through the Red Sea for the 2 Africa cable system are yet to be completed due to political tensions and security threats. Meta, which is leading the project, blames the delay on operational factors, regulatory concerns, and geopolitical risk. The holdups are disrupting the supply of broadband in underserved countries, causing financial costs for cable owners and investors, and prompting companies to consider alternative routes. We mentioned Meta there, Alphabet also facing the same concerns. And sticking with other corporates, according to the Financial Times, UBS Chairman Colm Kelleher has held talks with U.S. Treasury Secretary Scott Bessent about potentially moving the bank's headquarters to the United States. The discussions come amid uncertainty over Switzerland's proposed capital reforms, which could raise UBS's requirements by roughly $26 billion. The Trump administration is said to be receptive, even as UBS continues lobbying to ease the Swiss rules.
Well, coming up, AkzoNobel is set to buy coating company Axalta. We'll be speaking to the CEO at the Open. Plus, we'll also hear from Emirates President Tim Clark, who's been speaking to Guy Johnson at the Dubai Air Show in a day of big deals. But up next, a sea of red on traders' screens this morning as markets sell off. We'll bring you the latest. If you have any questions for your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
This reading of the data leads me at this moment to support a cut in the FOMC's policy rate at our next meeting on December 9 and 10 as a matter of risk management.
That was Fed Governor Waller reminding us that he is in the camp to push for this cut from the Federal Reserve when it comes to their December meeting. But the markets are really wanting to hear that from the more hawkish members of the FOMC. Those of them claiming that maybe the December cut isn't as clear as previously expected. Now, all of that combined is leading to more weakness in the equity market. And it's really surprising to think that we've had these hawkish officials on the FOMC really put that Fed cut in doubt. They're unlikely to change their mind until we get fresh new data. And without that schedule from the BLS on how they intend to release this backlog, we could be waiting for a fair few weeks before any of those FOMC officials change their mind on December. So we're continuing to see the slide in the equity market. These Nasdaq futures down around 1%. Yesterday's weakness was really all kicked off by this continuing debt spree from hyperscalers. Amazon, the latest to approach the market, borrowing $15 billion through investment-grade bonds. This coming in yesterday's session was really what sparked the weakness headed into the close. Now, it's all tied together now that this next stage of this AI tech trade is really hinged on debt funding. It really ties it in to the Fed narrative. And now that we have a hawkish Fed and one wanting to put that Fed cut in doubt in December, it's really leading the Nasdaq to have quite a tumultuous November. We're down around 6% from those all-time highs back in October. Kriti, we are essentially eyeing a correction. It could really all be down to NVIDIA's earnings tomorrow.
It's a lot of pressure on the world's one of the world's most valuable companies. Valerie, we thank you so much. Let's get a little bit more analysis on here. Just the extent at which we maybe should be panicking when looking at the price action of the last 24 hours. Haig Bathgate, CEO of Callanish Capital, flew in from Dubai just to have this conversation with us. Haig, how worried should we be?
Yeah, I think we had a very, very strong run. As you say, it's just gone back to the levels that we saw in October 1st. But we've got to remember that 90% of tech companies that reported almost beat expectations. Now, that doesn't usually happen at the top of a market. So, again, the market probably got a bit ahead of itself. We've had a bit of a dry up in liquidity, I think, on the back of the US government lockdown. And things haven't, we're 2 or 3 weeks away from liquidity drying up again. So to me, it's just a bit of sort of unsticking of some of the glue that we've had in markets. But I think the pullback has to be taken in the context of the run that we've seen recently.
Val and I were talking earlier on the show about just kind of what maybe triggered the sell-off. There were a couple of factors. I mean, there's been these repo funding pressures, to your point, for a little bit. There was the Amazon bond sale. There was a Bitcoin technical kind of drop as well. What do you think is kind of driving some of the catalysts here? What is the catalyst?
Yeah, I think the markets are very jittery about the amount of debt that's being raised clearly by the hyperscalers. And these are enormous numbers. But, again, you've got to put it in the context of how quickly these technologies are growing as well. And I think it's too difficult to predict who's going to be the winner out of these hyperscalers. So the sensible thing as an investor is just to have exposure to all of them at the moment until you see who wins out. But the user adoption rate is incredible. I mean, there are over a billion users in the space of 3 years. And if you look at it back in the tech days, it took you 12 years to get to that sort of user adoption rate. So the numbers here are exponential, I think, and that is the bit that the market's struggling to digest.
Well, hey, you said it there yourself. We've seen an enormous amount of beats from these tech players in earnings. Could really a beat from NVIDIA turn this around? I mean, it looks unlikely given we've already seen such a big string of beats and it's not led to gains in the Nasdaq. How are you thinking about that?
Well, I think the problem with NVIDIA is, they've beaten so many times now, it's almost sort of baked into the prices. But again, if you look back at the revenue increases, NVIDIA have doubled their revenue at every sort of reporting endpoint for the last 3 or 4 years. So the earnings are increasing at such a huge rate. So you look at them in percentage terms and they look like big figures, but you actually look at them in dollar terms, it's phenomenal what they're managing to do.
How are you connecting all of this to the wider things that are happening in terms of politics and the central bank and the Federal Reserve? Is there going to be something that could trigger perhaps the Federal Reserve to pare back some of this recent hawkish language that we've seen from some of these Fed officials? Yeah,
I think it's become obviously very politicized as well in the US. I think the good thing is that they've got the dual mandate of employment, and who knows when we're going to get the missed figures in terms of in terms of unemployment figures. But there are tentative signs, and you can see this through sort of medium and smaller companies in the US. And where we've got things wrong this year is we started to think that we'd see a spreading out of the rally, which just hasn't happened. You should have just stuck with the hyperscalers, and you'd have performed much better. But if you look at the share price performance of some of these mid and smaller cap US companies, they're predicting that there's going to be a slowdown in the US economy. But
in the slowdown, historically, when we have seen some of the the labor market, the data actually kind of decelerate, I think is a better way to say this. Growth stocks have always been the outperformer. That's happened time and time again, with or without the kind of the Fed greasing the wheels. Why is this time different? Shouldn't scale actually help the case for being the defensive pick? Yeah, I think the growth companies, you need to be careful about saying this time is different in anything. But I think the short-term difference with these hyperscalers is they are protected monopolies, and we haven't really seen this before. And you saw Trump say a few months ago in one of his clips, he said, look, at ordinary times we'd be investigating someone like NVIDIA and breaking it into its component parts because they've got such a dominant position. But because it's such a strategically important asset, they're not going to do that. In fact, they're going to protect it. And we saw, when all the tech bros had been in the White House, Trump came out the next day and said that if the European Commission slapped anti-competitive tariffs on Google or Alphabet, then he was going to go after them. So it's not just protecting the position within the US, it's protecting the position globally at the moment.
How are you seeing the U.S. economy faring next year? A lot of people are tying the AI story to GDP growth. We've seen that investment in data centers has really kept GDP quite supported this year. Do you expect that to still continue?
Yeah, I think the US is always the one that surprises in the upside of all the Western markets, and it's the most adaptable. So I think we do, and hopefully, because we've been positioned for this incorrectly, hopefully we see the second order effects, so the implementation of some of these AI tools and a productivity uptick. That's certainly the way that we are positioned, and that's what we think will happen in the US.
And what kind of indicators are you tracking in order to some way get a guide on how companies are and somehow monetizing this to make a more productive workforce?
Yeah, well, I mean, we're monitoring obviously the results of the mid and small cap players, because that, the statements are obviously, and people are incredibly careful how they're positioning this. I mean, you just see some of the advertisements from the big AI players like Palantir. They're now talking about how it's enhancing people's jobs rather than replacing them.
Yes, exactly.
So I think, we're looking at a lot of statement, a lot of nuance in terms of what people are saying. I can say as a company ourselves, we would need double the number of people if we weren't using these AI tools. We've got the advantage of not having the legacy. But the people that we employ are doing much better jobs. They're not doing the sort of admin roles that historically you would need to have people in situ to do. So that's the sort of stuff that we're looking at. And then obviously the jobs data as well. That's critical to spending. 2/3 of the US economy is driven by consumption. So we're looking at that as well.
Yeah, it's funny, tying GDP growth holding up quite well alongside a weak labor market. Are these companies just waiting to see how AI is going to change their workforce before going out and hiring anybody? And is that going to be a stasis for more than a year, or is there going to be at one point a decision that perhaps we need to lay off or we need to hire more workers in order to keep up?
Yeah, absolutely. Hey, with 30 seconds on the clock, I'm putting you on the spot for a moment. Is the data set on Thursday tradable? Yes or no?
Yeah. No, I don't think so. I think there's just too much noise at the moment, and it always gets revised anyway. So.
Yeah, absolutely. Haig Bathgate, CEO of Callanish Capital, giving us a little bit worldview of some of the market action. We are seeing futures selling off and selling off hard this morning. Coming up on the program, we'll hear from Leila, Fourie, CEO of the Johannesburg Stock Exchange at the Bloomberg Africa Business Summit. In the meantime, one eye, of course, on that summit. You are currently seeing live shots of a panel at the summit, including the South African Minister of International Relations and Cooperation with our very own Deputy Editor-in-Chief, Reto Gregory. The whole conversation, LIVE Go. Stick with us. This is Bloomberg. Thirty minutes away from the start of the opening trade. Take a look at the futures picture. It is spiraling. It's snowballing. The sell-off does indeed continue. Euro Stoxx 50 futures down 1.4%. The pain point this morning is coming in the DAX, almost down 1.5%. And not getting any better. The FTSE 100 down about 1.3% as well. You look over in the States, and you are seeing red on the screen, just not by the same margin, but perhaps just because the catch-up trade is really showing up in Europe after, Val, a 3.5% move in one of the Asian markets. Yeah,
it was a soggy session in Asia. The Nikkei dropping 3.2% is leading to further weakness in global equities, and we are getting a risk-off move into fixed income off the back of that. U.S. 10-year Treasury yields are down 3 basis points, and these German 10-year yields are opening up down 1.5. Is the market really going to start to tempt the fact that maybe this equity market weakness could mean the Fed is more likely to cut in December? That is a narrative we'll continue to keep our eye on.
Yeah, something that I think is a fascinating one. There's so many triggers. There's an Amazon story. There's a crypto story. There's a Fed story. We're going to dive into all of that analysis coming in throughout the program. But in the meantime, let's head back to the Bloomberg Africa Business Summit taking place in Johannesburg. Joining us on the ground with a guest is our very own Lizzie Burden. Lizzie, over to you.
Hey, Kriti. Well, there is a massive opportunity for investors here in Africa, but many investors also see a lot of risk coming alongside that proposition. I'm pleased to welcome a true expert on this. I'm joined by Leila Fourie, who is CEO of the Johannesburg Stock Exchange. Really good to have you with us, Dr. Fourie. Investor confidence in South Africa has been, let's say, knocked in recent years. From where you're sat at the JSE, I wonder what could be done to restore that confidence in these markets.
Well, Lizzie, if we look at what's happened over the last 10 years, we've had a decade of underperformance, macroeconomic headwinds, high unemployment, low growth, increasing fiscus. And what we've seen is actually a turnaround, point of inflection after the establishment of the Government of National Unity after the elections in May last year, and all indicators are starting to turn positive.
And how can South Africa's capital markets do a better job of channeling those funds into real economic growth and then benefiting the small and medium-sized businesses?
Well, Lizzie, the South African capital markets are certainly leading the way. We have increased our market cap, which is capital that's raised in order to increase companies' access to funding, by 5 trillion South African rands, 30%. We've seen an increase in the valuation of companies by more than 50%. That compares with the MSCI Emerging Market Index, which is only up around 29% year to date. We're seeing net foreign inflows both in the bond market and also foreign holdings in local assets increasing. And all of these factors are indicating an improved sentiment and improvement of capital flows into the country. And that capital ultimately gets deployed in job-creating, CapEx-related projects that improve the growth.
And indeed, some companies are choosing to list here over than, for example, London. What do you think you're doing that's beating those rivals like the LSE?
Well, we were delighted to welcome Optasia to our markets recently. They chose South Africa over other developed world economies. We will be welcoming in the next year Coca-Cola Hellenic, which is a global player, which will be the second largest bottling company by number. We'll also be welcoming Canal Plus, which is currently listed on the LSE and will be secondary listing in South Africa. So South Africa is becoming a global hub for capital raising. We have deep capital markets, very liquid, much more liquid than our real economy would suggest. And the future is looking bright for the country.
But do you think there's further to go on deregulation, for example? We're speaking to Jonathan Oppenheimer later. He says that the government just needs to get out of the way of entrepreneurs. Do you agree with that?
We are working with National Treasury and our policymakers. We are driving a project called Project Phumelela, where we are encouraging our policymakers to contemplate changes in policy to enable dollar listings, to enable dollar-based collateral, to reduce the cost of capital. And all of these aspects are really important to unlock the value. We're also working extensively with private sector to support our National Treasury in the drive to improve our sovereign credit rating, which is such a fundamentally important part of cost of capital for our country.
We're, of course, here ahead of the G20 and the B20. A key theme is the energy crisis, which, of course, is so closely tied to growth. I wonder what role capital markets can play in financing South Africa's energy transition.
Capital markets plays an enormously important role. We currently host more than 350 billion rands worth of debt on our markets through Eskom. We are investigating impact bonds, and we also fund a large number of the renewable projects which are in the private power production sphere. And so public and private sector are working very much together to address the crisis. Eskom turned a profit for the first time recently, and having what we called load shedding or blackouts, power rolling blackouts, a thing of the past, has had such an important role to play in the sentiment of our general consumers and business.
You've also talked a lot about digitalization and inclusion. How's the JSE leveraging tech to try and modernize the market, try and get more South Africans involved in the investment landscape?
The JSE is using AI, and we are digitizing all elements in our technology stack. In South Africa, there is 4.5 billion rands worth of unclaimed dividends from the man in the street who doesn't know they have dividends owed to them.
Yeah,
we've introduced
India has a much more domestic market. Yeah,
we've introduced a digital solution, and we're running a claim called Claim It, and we seek to reunite those shareholders with their dividends. We're also introducing world-class tech in our information services business, where we're providing companies like Bloomberg and all of our trading community with much better quality infrastructure to disseminate our data and to provide genuinely thoughtful analytics. And then, of course, our tech stack is being completely transformed through the use of AI.
Well, Leila, I know you've got lots of panels to get to today, but one last question. If you could trigger one engine of growth for South Africa, what would it be?
Well, of course, my engine that I'm focused on is the markets. We are starting to see that. However, in the broader economy, we need to see growth and unemployment coming down. We need to see youth unemployment coming down, and that can only happen through capital formation that reaches the right businesses. We've brought on a private placements environment, and we're starting to see the listings market open up, where we've genuinely seen a large increase in our listed companies, and trade flows are starting to happen. What I'd really like to see is that SA Inc. is revalued back to what their forward PE is indicating or what their NAV is indicating. And we're halfway there, 50% up on markets. We've still got a way to go. All
right, well, Leila, it's been a pleasure, as they say here in Jersey. Thank you so much. Leila Fourie, CEO of the Johannesburg Stock Exchange. Back to you, Kriti.
Lizzie Burden at the Bloomberg Africa Business Summit in Johannesburg, of course, speaking to Leila Fourie. We thank you so much. In the meantime, of course, we continue to monitor that summit and all the fantastic conversations we're getting out there. You're seeing images from a panel in the summit right now, including the Egyptian investment minister, Bakri and Brothers CEO, and the international president of Standard Chartered, of course, with our very own Jennifer Sabasaja there. The whole conversation available to you on LIVE Go on the Bloomberg terminal.
Well, coming up, Credit Agricole is targeting profit of more than 8 billion euros as part of a new strategic plan. More on that next with your stocks to watch. This is Bloomberg.
I think in equities today, investors should have maximum 40%. If you're at 40% in stocks and 20% or 25% in bonds, you've got another 35, 40% to allocate. And I've been very, very bullish on gold. The rest, I think I would be in cash, because I think valuations are just incredibly high.
Jeffrey Gundlach, Dumble Line Capital founder. They're speaking last week on Bloomberg's Odd Lots podcast, being bearish as ever. Surprise, surprise. But making the same point that I think is driving the market sentiment this morning, which is this concern around valuations, the concern around lending, and kind of the overlap that you're starting to see between private and public markets. Joining us now with a little bit more insight, I have to say, a long time coming, is Frederick Stevenin, co-managing partners over at PIA Partners. Frederick, lovely to have you. Thank you so much for joining us. You picked us on a great day, I have to say. But I think this is helpful. You and I have had several conversations about where the valuations lie, how excited people are getting about this market. We have a almost 1 to 1.5% sell-off on our hands, 17 minutes away from the opening trade here in Europe. Walk us through what you think these jitters are about.
Well, clearly, the world has changed dramatically in the last 2 years. You have more volatility, you have a higher risk of disruption, and therefore what we've all been struggling with is are we pricing this disruption today?
Do you think we are?
Difficult to know. I mean, I do think the valuation have gone a bit ahead of our skis in terms of where we are today, and there's an opportunity for correction. As you know, and we'll probably talk about it in a minute, the US market are clearly much more expensive and pricey in terms of multiple than what we see in Europe. So it's all a question of relative value. And the question we need to ask ourselves is where do we sit on that relative value versus growth?
Coming from the private side of the market, how are you viewing the private credit, private equity's role in this tech trade right now? Are you seeing that this is opening up another door, another avenue of business for you? Or is this something that perhaps private equity won't get too involved in?
No, I think private equity, obviously, key role, and I talk about it more as a role in society than financial market. It's really about transformation. I mean, we generate alpha through transforming the business we own, through basically optimizing and making them better. If you think that's the key thesis that underwrites our positioning, then there's a role for us. If you look at the traditional sectors, and we're talking about tech, but let's look at what represent a bigger part of the European economy, traditional sector. There's a key role for private equity to kind of buy these businesses, help them drive more growth, help them be more effective, bring technology to them, and I think that thesis is still absolutely what we need to underwrite.
Yeah, a lot has been said about, not just this AI trade, but how businesses are going to adopt it and who's going to adopt it quicker. Some have said that Europe is actually a better tune to make these kind of adoptions, have these kind of disruptions in industries and in sectors. How are you positioning your business in order to capture that kind of business?
I think the biggest part of, to go back to a very good question, the biggest part of the transformation is about using technology to improve the businesses. The reason Europe is a better place to do it is because we're behind. So we don't start with investments like the US that they've done for the last 10, 15 years. A lot of the businesses in Europe that we acquire are what I like to say sleeping beauty. How do we make them better? How do we kind of wake them up? And that's key thesis about how bringing them technology best in class operational skills so that we can effectively drive performance. That skill set is there, and to your point, that's why Europe is attractive. It's probably behind in terms of using these tools, and therefore there's a bigger opportunity in terms of delivering performance.
And that's a conversation that applies not just to the tech ecosystem, but arguably to the defense ecosystem as well. And we know that has been such a key bull case or component of the bull case for Europe. But Frederick, I have to ask you, if we're seeing some of these valuation jitters in the public markets and arguably in the private ones as well, then that's been a case for, I want to say, the last 2 years, certainly. Is that something that will bleed into some of the core sectors of Europe in the both public and the private spaces, the defense sector, the luxury sector? My favorite fun fact is that Rheinmetall trades at a higher PE ratio than NVIDIA at moments. And I think I'm curious how much of this is a tech-specific issue as opposed to a broader investment issue.
Well, there's two answers to your question. Let's start with the easy one. Europe today, ex-tech trades probably at a 30% discount to the US in multiple terms. And that includes Rheinmetall, that includes the whole market. So your first question is that 30% enough in terms of growth-adjusted multiple?
Yeah.
Probably is, because the European growth is probably coming closer to the US with the policy change we've seen, with the investment that the German government is making in utilities. So that's the first answer to your question. The second part of that, which is slightly different, is the opportunity. It goes back to the opportunity. Can we effectively drive more growth on a relative basis, investing in businesses in Europe and dusting away inefficacy? We probably can. There's an element of policy change. Europe red tape is much higher than the US, so is that going to go away? That's what the governments are telling us, but we need to see the facts rather than the principle. But yes, there's a bigger opportunity. Now, the final topic is we need to spend on defense, but most of that defense spend is going to be basically building utilities, building an infrastructure that can cope with mobility, which is probably the key driver of the effective military spend that we need to do. And so all of that together means we probably have more growth in Europe. And more growth, which is not targeting the tech world, but targeting, I guess, a number of traditional space in which we at PI deploy capital in.
But in targeting those infrastructure projects, that comes at a massive expense to the government in terms of some of their fiscal responsibility. And we're seeing that happen across Europe. We're seeing that here in the UK. We have a fun autumn budget next week that we are all counting down to. And of course, in the US as well. How much of the fiscal worries and maybe the concerns that some of the fiscal promises won't ultimately materialize is affecting the financing in real time? Are you having that conversation with the businesses you're working with?
Yes, well, in two ways. One, it is converting into higher interest rate because government, borrowing means, they have effectively paid more to get their money, which converts into the cost to our business. To your question, what's reassuring about the spend is really it's coming from, I guess, Northern Europe. A bigger part of that spend is coming from government, which probably have the ability to raise capital quite effectively. I mean, Germany, Scandinavia are going to be a big driver of those spends. And their policy historically has been more prudent than Latin Europe, and therefore they probably have more capacity to borrow in the future than others.
Talk to us a little bit about the trickle effect and maybe the delay that you see from what you're seeing in the public markets to the private markets. We've talked about this in the credit sphere and then the equity sphere. How quickly do we start to see if this market action you're seeing this morning is the beginning of a larger pullback or retracement or drawdown? How long before that shows up in the private markets?
Well, I mean, it's a difficult answer because fundamentally the first question you need to ask yourself, are the private market more expensive or cheaper than the public one? Historically, the private market were cheaper. Mm-hmm. And then, therefore, you could argue there was a buffer between when public market were coming down, would it hit the private market valuation? Right now, it's a bit of the opposite. So you could argue the gap in valuation is higher, and therefore the drop in the public market will have probably a faster conversion in terms of private market value. Is there a rule? No. I guess the market are difficult to read, but intuitively I would tell you yes, there will be, if the public market corrects, you will see a private value correction happening afterward.
Well, a lot of that cushion to that correction could be any further announcements from the Federal Reserve. We know they're under a lot of political pressure to keep rates low. Does that play into your the way that you view assets and investments? Are you penciling in an aggressively dovish Fed next year?
No, I mean, again, we're not, because that's not our business. But I think fundamentally there is a conversion. There's an element of valuation dripping from the Fed's policy. There are costs in terms of cost of capital that we need to look into. And finally, I think, which I think is the mirror of that, is the expectation of inflation. I think inflation, rather than the cost of debt, is really a much bigger impact on our business in terms of our ability to push it through, our ability to recover from it. What is the cost consequence of a higher labor cost environment? All of those probably have a higher impact than simply the cost of capital from the Fed's rate.
All right. Well, it's Frederick Stevenin, the co-managing partner at PIA Partners. Thanks for joining us around the table for a discussion around private markets. Now let's get your stocks to watch ahead of the European Equity Open with Chloe Melly. Chloe?
Good morning, Valerie. Let's start with some M&A, this morning with AkzoNobel, the paint maker, agreeing to combine in an all-stock deal with a smaller rival called Axalta based in the US. So let's see how the market reacts to this morning. We have seen the shares in AkzoNobel being on quite a steady path of decline over the last few years. This is a company that recently cut its outlook because of that lower demand in those key end markets. So let's definitely watch out for this at the open. Those are two companies that had already tried to merge back in 2017. Let's see if this second chance is being taken well by the market. Moving on to more deals, and Amundi, Europe's largest asset manager, has taken a stake in ICG based in London, and has also agreed a 10-year commercial agreement with ICG to expand its footprint in private markets. So let's see how the market reacts to that this morning. This is part of a broader strategic plan for Amundi, which also includes a push into Asia. So let's see how the market reacts to this new partnership and those new ambitions today as well. And finally, let's stay over in France and go over to Crédit Agricole, which is targeting a net income of 8.5 billion euros by 2028 under a new plan by the new CEO. We'll see if that lifts the shares, which have already been on a pretty good run so far. The company has said that a lot of that growth will be coming from outside of France, and there's a real focus on Italy. Crédit Agricole has recently built up quite a significant stake in Banco BPM, and the CEO has said that he was pursuing both organic and non-organic growth opportunities in that country. So we'll be keeping an eye on that as well moving forward.
All right, Chloe Melly walking us through some of those stocks to watch. We thank you so much. Broadly based, we do, of course, have a sell-off on our hands. Chloe mentioned their AkzoNobel. We will speak with the CEO about the Axalta deal news coming up shortly on the program. In the meantime, futures continuing to drop. I will say they're off their earlier lows. I saw DAX is down about, futures at least is down only about 1.2%. I'll take that over a 1.5% drop that we saw earlier in the session. To me, what's interesting is the bond market, that people are actively flocking to a market that is to the rates market, I should say, even though we are starting to see this worry about valuations, worry about hawkishness. You would think that the opposite would happen.
Yeah, look, it's nice to see that there is a bid into treasuries, because yesterday that was absent among the Amazon debt deal that really pressured yields higher, at least in the long end. But if we do get the market starting to tempt this Fed cut, that could be something that could maybe stabilize the equity market fears at the moment. But the fact is, we need that BLS data in order to really change the narrative on the Fed. And they haven't released a schedule yet, Kriti. All we get is that delayed September non-farms on Thursday, but really no other updates on the other data releases. And it's hard to be penciling in a change of narrative from the Fed, frankly, without that.
I mean, Bathgate said it best. This is not a tradable data print by any regard. But I think maybe the existence of that data print could provide some calm to this market. That being said, we have plenty of other factors this week to look at. We have NVIDIA earnings. We have that data print. We have plenty of inflation data from around the world as well, not to mention some of the geopolitical standpoints as well. The markets are selling off. The opening trade is next. This is Bloomberg. A few minutes ago until the opening trade, red across the screen. But I think yesterday's setup is so crucial to this, because this feels like a session that's going to be a bit of a catch-up trade. And it's because here, everything was fine when the Europeans left the desk, and then it got worse for the Americans. This is where you see the sell-off of almost 1% in the S&P 500. You had valuation jitters. You had some concerns about the Fed. You know that repo funding stress has been weighing in the background. You had Bitcoin dropping below 90,000 tick by tick. I could overlay Bitcoin here, and that chart would look identical. Also speaking to some of the bond issuance you saw from the mega-cap tech players, lots of different catalysts. The end result is that futures are lower here in Europe. The underperformer of the morning is right here. So DAX futures down about 1.5%. Val, the sell-off continues.
The sell-off continues, but we do have some individual stocks to keep an eye on for individual news stories. Let's keep an eye on AkzoNobel. They have recently announced an acquisition of Axalta. This is an M&A when it comes to the paint business. We'll keep an eye on how those shares move. Perhaps investors will tell us whether AkzoNobel paid too much or too little for this company. We're also keeping an eye on Amundi. They have agreed to take a stake in ICG in order to grow into private markets. So keep an eye on that space. And lastly, Credit Agricole giving us an update on their medium to long-term plan. They want to see income grow by around 9 billion euros in the next 3 years. Let's see how the market takes this medium to long-term update from the banking sector. Kriti?
Yeah, lots going on. It's really fascinating here. You've got the banking sector very much in focus. You have a tech trade where you do have to catch up. You saw some pretty violent market action over in the Asian session. How much of that feeds into the European session, given that yesterday we only saw a 1% drop in the S&P 500. That seems to be magnified across Europe. Remember the futures picture, the DAX was the underperformer. I wonder how much of that we see this morning as well. Let's get these markets open. The FTSE 100 is virtually unchanged at the open. Give it a second to kind of trade out. It might take you a minute to start to see some of the volume shake out. But remember, we are expecting a sell-off. And there it is. The FTSE 100 down about 0.7% and dropping as we speak. Some of the early action, some of the early underperformance really priced in to the periphery. The IBEX down a whopping 1.6%. And you can see the FTSE 100 really isn't able to hold up very much, Val.
Well, look, when it comes to the sectors, maybe no surprise in this risk-off move. The one at the very bottom of the list is banks. The sector is down around 2%. We're seeing some weakness in HSBC, some weakness in Banco Santander, and the likes of UBS as well. So broad risk-off move when it comes to the financial sector. We do at the moment have just one sector in the green. That is healthcare, but the remainder at 19 in the red. And when it comes to the spread between the stocks up and down, we only have 21 stocks in the green so far to start this morning's trade. The remainder 495 in the red. So this is very much tilted towards a risk risk-off move. The biggest points mover to the downside is HSBC. So again, banks weighing on the broader indexes this morning.
The upside move is kind of fascinating. Healthcare is the outperformer. Is that a defensive trade right off the bat? We should also mention this is the sector that's been kind of beaten up lately. A lot of this has to do with some of the concerns around the Swiss pharma sector as well. This has to do, there's a whole Novo Nordisk, Metsera trade in there that's been weighing on the sector broadly in the last couple of months. There's a couple of drug trials that didn't quite work out in the States. You have seen that read-through show up into the European healthcare sector as well. So this also feels like, even though it's seeing a broader sell-off, that green on the screen might just be a little bit of a rotation when it comes to that sector.
Yeah, and it does look like it is down to Roche. Shares are jumping around 6% in Switzerland. They did have some successful phase 3 trials when it comes to one of their drugs. So perhaps the main bright spot across Europe today amidst a sea of red, frankly, across our screens. There you can see some of the decliners are also the basic resources stocks, Rio Tinto and Glencore, steeply in the red this morning.
Not surprising. If you're worried about a China read-through, if you're worried about some of the Asian price action, those is immediately where you're going to see some of the pain points. Let's talk about an individual micro story. It feels like a macro kind of day. There is a micro story in the works, though. AkzoNobel has agreed to acquire smaller rival paint maker Axalta Coating Systems. It's a cross-border deal. We don't get a ton of those here in Europe, creating a coatings company with an enterprise value of about $25 billion. Well, I'm pleased to say we're joined now by the CEO of AkzoNobel and friend of the show, Greg Pugh-Guillaume. Greg, a pleasure to have you on the program. Thank you for making time for us this morning in this very exciting news. I'll throw it over to you. Walk us through the merits of this deal and why now when you've considered it before?
Well, it's a really exciting combination. It's something that we've looked at for many years. AkzoNobel and Axalta make a lot of sense together, a lot of business sense. As you said, it's going to be $17 billion of sales, $25 billion of enterprise value. It's very synergetic, $600 million of just cost synergies annually. And I think this is also a good remedy for the macro blues. In a time of uncertainty, having mechanical value creation like this makes sense. And it's a no premium merger of equals, where AkzoNobel is paying €2.5 billion to its shareholders up front. And then we make that a 55-45 deal, 55 for Akzo, 45 for Axalta. I'll be the CEO of the combined entity. Rakesh, Axalta's chairman, is going to be chairman. And then we'll be off to the races.
Can you talk us through your decision to move your listing now to being primarily in the New York Stock Exchange? You were dual listed, but after this acquisition, you plan on being primarily listed in New York. What drove that decision?
Well, if you look at the investor base of AkzoNobel today, 62% of our shares are actually in U.S. hands. The coatings space is heavily dominated by U.S. investors. So as we combine the two companies, it really makes sense to be listed in the U.S. and might as well keep it simple and have a sole listing in the U.S.
Greg, speaking of that listing in the U.S., you also made a key point in your previous comments there, talking about a no premium merger of equals. Can you just walk us through decision-making on what got that across the line? Were there some compromises you had to make in those negotiations?
Well, there's always compromises, particularly on things like the governance. You know, who's going to be running the company? How's the board going to look like? What's going to be the parity? What helped the transaction happen is that both companies were actually doing well. So as both companies were performing, we're subject to the same macro pressures. So that's also an equalizer. And at the end of the day, there was a window from a valuation perspective to make it work. We were willing to find a workable arrangement on the governance. I'll give you an example. I'll be the CEO. Rakesh is going to be the chairman. It's going to be a Dutch domiciled company, but it's going to be sole U.S. listed. And also, we're doing away with all the traditional bells and whistles that you have in Dutch governance. So it's going to be a one-tier board, not a two-tier board. We're taking away the Stifting, which was the foundation that was kind of a defense mechanism on top of the company. So we're making it as much as a U.S. company as you can be as an NV. And we think this is going to be exciting for investors who are mostly American investors anyway.
Does this decision to, I guess, as you were just mentioning there, become mostly a U.S. company in the way you operate, does that have anything to do with U.S. tariffs and perhaps having a better supply chain in order to skirt around some of the highest tariffs out there that I know that you and your competitors and many out there who are in goods trades, imports and exports have been dealing with a lot of tumultuous decisions around?
No, it doesn't, because AkzoNobel has 130 factories around the world. We've got about 30 of them in the U.S. We're very much a U.S. company in the way we operate in the U.S., and the tariffs are not an issue because we've got local production very much as the U.S. government desires today. So we go from 130 factories around the world to 170 factories around the world. If anything, that makes us even more local, but that wasn't an issue in the first place. It really is about reinforcing ourselves in the U.S. market because it is the strongest coatings market in the world. But it's also having a face that our investors are comfortable with. And once again, our investors at AkzoNobel are mostly U.S. investors, and our peers are mostly U.S. companies. So we're joining the party, and we're excited to be U.S. listed as we will be when we close the transaction.
Greg, it's fascinating that you want to join the party in the U.S. at the moment because we are literally on a day where we are seeing a massive sell-off. We're worried about perhaps some of the market reaction that we are seeing. That being said, take the markets out of this. The economy is also slowing down broadly. So some would argue that the party that's been happening in the United States will not be lasting very long. Just from your perspective, what kind of demand trends are you seeing? Are you seeing a slowdown from some of your customers?
Well, I said joining the party in the U.S., maybe it's, buy low, sell high. But at the end of the day, we're very confident about the strength of the U.S. markets. We've seen some of our markets go sideways this year, but we are seeing signs of life towards the end of the year. And we think this combination with Axalta that reinforces us in the U.S. is going to be very beneficial for our company and our shareholders over time. So it's, you don't do these mergers based on a specific window of the market. You do it because it makes sense over time, and this undeniably does.
All right, Grégoire Poux-Guillaume, AkzoNobel CEO, joining us this morning at the market open on a very exciting day for the company, of course, as we talk about merging with Axalta Coating Systems. We thank you so much. He was talking there about the party in the United States. We talked about the sell-off that we're starting to see. Let's get a little bit more analysis on that from a macro perspective. I'm excited to bring Kevin Gordon, head of macro research and strategy at Charles Schwab, over to the show. New fun title, by the way. Congratulations on that promotion.
Nice to see you guys.
It's nice to see you. You picked a great day. I do feel like every time you come here, the market sells off.
Yes.
So maybe we should.
It only happens when I come to London.
It does. So. It does. And I think it's because we're all clamoring for your take on this. Is this a pullback or is this a pop?
So it's interesting because the fabric of the sell-off up until yesterday, I would argue, was actually more concentrated really in these highly speculative, junkier parts of the market, especially if you're just looking at the U.S. So the overlay to a year like 2020 was actually really interesting because what was really rallying at the end of that year into 2021 was SPACs and meme stocks and non-profitable tech. There's a similar flavor of that this year, where most of the concentration in terms of that significant outperformance, both year to date but also off the April 8th low, has been in quantum computing and drones, and it's been in these little bit more sort of arcane and niche parts of the market. It hasn't really started to impact higher quality large cap tech until, I would argue, a day like yesterday, where there was a little bit of a flip, where it started to infiltrate more of what we think of as sort of the traditional large cap space as opposed to the more speculative stuff. But even if you look at performance over the past month, the underperformance and the severe drag has disproportionately been in favor, or maybe out of favor of those speculative parts of the market. So I still think that there's a relatively healthy underpinning to all of this, especially when you look at breadth under the surface. But I will say, one of the things that's been a bit more disappointing over the past week is we've failed to see so far a pretty impressive jump in, a metric that I love to track, which is the percentage of companies above their 200-day moving average. You just haven't seen that much traction there. And I think if that slips below 50%, then you have to start reassessing if this is going to be maybe more of a drawn-out severe correction.
Well, Valerie and I were debating, and we've debated, I think, with all of our guests this morning, what the catalyst actually is. There's a lot of them here, right? There's the bond issuance, there's the Fed, there's the cryptocurrency piece. What's actually driving this?
It's really take your pick, because I think, a lot of the stress actually started, and what we started hearing was this narrative around the government reopening in the U.S. and us finally starting to get a lot of the data. And I think part of it is driven by the fact that we're really facing this data hole, H-O-L-E, not W-H-O-L-E, in October for U.S. data, because so much was just missed in terms of collection. I mean, especially when you look at something like payrolls, the reference period was missed. Arguably, it was missed in November, although that's probably a little bit easier to retroactively go back and get some of that data. But for something like CPI, you're looking at a whole month of data collection that just did not happen. So, you talk about that affecting monetary policy, the Fed really being hamstrung. I think at the next time they meet, there is a chance where they're just in total blackout mode in terms of the data that they have available to them. So I think a lot of it was sort of this realization that there is going to be a little bit of this flying blind period, or at least impaired vision period for the U.S. economy in terms of the official data that we get. Not to say that we don't have access to certain data that have carried us through, and I think corporate earnings was probably the best bridge that we had. But I do think that has been a fairly significant driver, especially because the reality is we're probably not going to get a clear read on the U.S. economy until, I think, well into the first quarter, maybe even closer to the summer. You think about fourth quarter GDP being artificially depressed by the shutdown, shaving off 1 to 1.5 percentage points. Then you think about first quarter GDP artificially almost inflated because of that bounce back from everything reopening. So it's going to take a while for this to churn.
Yeah, I guess we all want clear data. UK is struggling with those kind of pictures as well. But even when it comes to the U.S., even if we did have a clear picture, the labor market on a weakening track, GDP looks okay. I mean, that puzzle in itself, someone is going to have to interpret on what that means to monetary policy, because it's not even clear if that was, if that was the data we got from October, if that did move into November, what the Fed should do off the back of that.
Well, that dynamic that you point out is really that's the supply story that we've been seeing so far in the U.S. this year, and mostly driven by there's a heavy piece of it, a heavy chunk of it driven by just aging demographics that we have in the U.S. Not a unique U.S. phenomenon. I mean, it exists across developed markets, but specifically when you look at something like immigration policy, I mean, our immigration flows have slowed considerably, basically down to stall speed. We've also seen a pickup in deportations. The fact that you have payroll growth slowing as much as it did, especially when we got revisions to summer jobs reports, showing that effectively it had slowed to zero. But then you have the unemployment rate remaining relatively stable, just shows you that that's more of a labor force supply crunch as opposed to the significant drop in demand where you're seeing, layoffs really spike. So that's how GDP can continue to grow, because the stock of labor is still relatively high. I mean, you're bumping up still against all-time highs. We'll see if that changes in the jobs reports that we get going into 2026. But the fact that you have that month-to-month, income growth for the average consumer in the U.S., that keeps the spending train in motion, that essentially keeps GDP in motion.
Yeah, I'm really keen to hear more of your thoughts on immigration, because I don't think that's being discussed enough. The fact that, border crossings have basically dropped to zero. And essentially, you can even look back onto what happened during COVID under Biden. There was a lot of immigration to the U.S., and that was something that's kept inflation substantially above the Fed's target. Now, flipping that around, a lack of immigration, does that imply a disinflationary force to you, or is just the nature of GDP at the moment now will paint a different picture?
Well, it's interesting, because if you look at the forces, well, certainly right now, I would agree with how the Fed assesses this, and that the labor market is not some massive source of inflation. So I think what is still plaguing us from an inflation standpoint, and I will say, hovering, yes, we're averaging around 3%, but that's very different than being, closer to 5 or 6% like we were a couple of years ago. That was happening in the context, as you mentioned, of a labor market that was just red hot and on fire. Now we're very much in cooling mode. So there's just not as much coming from the wage inflation side of things. Does that change a little bit next year? I could see that actually happening in certain sectors when you think of those that are more dominated by immigrants, and in particularly undocumented immigrants.
Like used cars, for example.
Yes, there's that. There's construction, leisure, hospitality, manufacturing, retail. So to the extent you get any of a demand pickup in those sectors, whether it happens via some fiscal stimulus, if we are going to see $2,000 tariff dividend checks go out to U.S. households, if that does become policy and you do see some more demand in those sectors, that's where I think there's a little bit of a mismatch from an inflation perspective, where you could see some stress. But I just think that most of the lingering inflation is going to be what we've already seen, where most of it's driven by the services side. You've seen a little bit of a pickup in goods because of tariffs so far. Whether that extends into next year, I think it's still too soon to tell, because companies have been able to manage that price handoff or lack thereof so far. But I still think that there's enough lingering pressure to keep you closer to 3% as opposed to 2%. And that really hamstrings the Fed, especially because this is mostly supply-side driven inflation. This is not demand-side driven inflation. Very different set of rules and set of sort of a different environment that the Fed has been used to in the modern era.
And yet there are still a lot of rate cuts priced into this market. Is this market overestimating not only the Federal Reserve's dovishness, which may ultimately come to fruition in 2026, depending on the cast of characters, but also overestimating the impact of the fiscal spend that's been promised by not only the Trump administration, but by a series of other investors around the world?
I think the overestimation is still on the part of monetary, not as much on the part of fiscal. I mean, when you look at, we've actually already started to see some benefits from the big, beautiful bill so far this year. We're only expected to see more next year. When you look at the tax rebates that Americans are expected to get, come April, expected to be relatively substantial. And if we do get more tariff dividend checks, if that happens, that'll be another round of fiscal. So I think that on the monetary side, and yes, you're seeing this sort of firsthand in the market, I would argue that's another piece that's driving the sell-off. Some of the more speculative parts of the market that have really high debt levels, and even down the cap spectrum into the Russell 2000, that's where you've seen the most pockets of stress so far this week. So I think that's more of a rate play and the pricing out of a rate cut, at least in December. But I would layer on to that, and I think what's more important, it's what's really going to cloud the outlook for the Fed, is what happens with the Supreme Court case with Governor Lisa Cook. I mean, that really has the potential to change a little bit more of the fabric of how the Fed is going to operate in 2026. So, and nobody has any insight as to how the court's going to rule. We don't start getting the oral arguments until January 21st. So after that, I think you can start to maybe reassess how you're thinking. After the decision, you reassess or confirm, depending on what the decision is, what the thinking is around how the Fed, decides to handle both labor and inflation going forward.
We've got a fun 6 weeks ahead of us to the new year. Kevin Gordon, head of macro research and strategy over at Charles Schwab, joining us around the table. Lots going on when it comes to this market sell-off. Coming up, more coverage from Bloomberg's Africa Business Summit. Up next, an exclusive with Patrice Motsepe, chairman and founder of African Rainbow Minerals. This is Bloomberg.
Welcome back to the opening trade. We're 21 minutes into today's cash equity session, and there is a lot of red out there. The Eurostoxx 600 is down 1.2%. We are trading in the red when it comes to U.S. markets as well, but we're well off the lows. The Nasdaq futures are down by 0.5%. S&P 500 futures down by 0.4%. Remember, the S&P 500 index did cross below its 50-day moving average in the session yesterday, so risk is really feeling on a back foot ahead of these key NVIDIA earnings on Wednesday after the bell. But joining us now to discuss this and more is our Markets Live executive editor, Mark Cudmore. Mark, what is going to take these equity markets out of this negative funk that we've seemed to have been in now for a few weeks?
I think it's mainly going to be time, Valerie. I think we just got overextended to the top side. We had not really seen any volatility in the kind of equities boom of the last 6-7 months. So a pullback started a couple of weeks ago, and we've talked a lot on the show in the last few weeks about how we didn't think that pullback that started at the end of October was exhausted yet. I'm not quite convinced we've seen exhaustion yet, but I feel like we're getting closer to that point. There's certainly no signs that the AI bubble is bursting. This is just about a little bit of froth coming out of the market. The bubble will reinflate again going into next year. And I expect that NVIDIA earnings will confirm that narrative, that there's still the spend going on, there's still the growth in capex and in revenues for names like NVIDIA to justify the bubble inflating for now. It will all come crashing down at some point, but not just yet. Now, despite the fact that I expect NVIDIA to kind of confirm that the AI bubble has more to inflate, I actually am not convinced there'll be positive price action. We've talked about this before, but over the last 15 months, generally NVIDIA earnings have actually been a sell the fact events. They've generally shown exploding growth, but people have used that as a chance to take profit on one of the most phenomenal stock stories, and that might kind of feed into the broader narrative.
Certainly something we're going to be watching very, very closely. Mark Cudmore, I'm sorry we don't have enough time with you, but of course we're looking forward to getting your analysis throughout the rest of the week. MLIV Go for more from Mark and the rest of the team. In the meantime, let's get back to the Bloomberg Africa Business Summit with an exclusive conversation between Patrice Motsepe, billionaire executive chairman of mining company African Rainbow Minerals, and our very own Jennifer Sabasaja. Take a listen.
The multinational corporations that are either based in in America or in Europe. And I think to a large extent the same applies to the South African portfolio managers and those who invest in some of the biggest companies in South Africa and in the rest of the world. And of course their risk profile is significantly different because they don't have to invest in any particular country or continent. They look for the most competitive countries where the risk is low or acceptable and the returns are very high. So if you talk about what you were referring to in terms of which industries am I most excited about, I like when you talk about industries because that's relevant, but it's always about the companies.
Specific companies.
The businesses that invest in those industries because it's about the management. It's about the CEO. It's about the specific countries within which those companies operate. So we are in 38 countries through Sanlam in our partnership with Allianz Financial Services. We're doing exceptionally well. We've got a bank here, Time Bank, that has got 12 million clients, and we made a huge investment in the Philippines. And then, of course, we're involved in mining. We have a very exciting renewable company, African Rainbow Energy and Power, and the CEO is most probably one of the most knowledgeable executives on the continent. He was the CEO of Eskom, Brian Damas. And we've made a lot of investments in telecommunications, in technology and agriculture. But Africa is exciting.
But so it's not sector specific. What do you look for when you're trying to find the next time bank? Let's say if you're interested in data centers and AI, what is it that you're looking for? Is it the personnel? Is it, give us a sense of what ARM or ARC is looking for.
Well, African Rainbow Minerals has got 30,000 employees in manganese, iron ore, PGMs, and there's the mining company. And of course, in the mining industry, it's all about grade, it's about cost of production, it's about cash flow, it's about dividends, it's about the performance of the share price. African Rainbow Minerals is listed on the Johannesburg Stock Exchange. And we merged our company called ARM Gold with Harmony. And Harmony's got about 50,000 employees, and it's doing exceptionally well. Copper mines in Australia. There's a huge investment that we are currently looking at in Papua New Guinea. That may require, we've got a partnership there with Newmont that might require as much as $4 or $5 billion to be invested down the line.
Is that what you're planning on doing?
Well, we'll be there for the long term. I mean, copper, if you look at the energy transition, if you look at the green economy, climate change will forever be with us, will forever be a challenge. And copper, as well as some of the minerals that we are mining in South Africa, are very important for the green economy, the transition. We're also trying to get a balance because many of our investments tended to be long-term. I mean, some people are good at making money overnight. I unfortunately have a lot to learn in that regard.
Oh, come on.
Yeah.
Really?
So we tend to do reasonably better with a 3, 5, 7, and 10-year perspective.
Can I ask you about copper versus gold? Because this year we've been looking at the price of gold. I imagine that's been quite a boon for Harmony Gold and for your investment there. But you mentioned copper. In the long term, are you looking at maybe which mineral might potentially be more beneficial to the business?
Gold is a very cyclical business. I mean, over the last few years, it's done exceptionally well. And we started with 22% equity in Harmony when we merged ARM Gold with Harmony. And over the years, the gold mining industry has experienced enormous challenges, and that's why we have to diversify. But again, we'll always be in gold. And it has done exceptionally well. The price has gone through the roof. The central banks are buying gold disproportionately. And but our objective has always been to look at gold from a medium to long-term perspective. We're getting good dividends. We've got about 20 billion rand in fact, we've got 13 billion rand of cash, and we've got facilities of an extra 7 billion. And a lot of that money is going to be used in part of it in Australia and part of it in Papua New Guinea. But Australia and Papua New Guinea is primarily copper because, from an African perspective, as well as from a shareholder perspective, you've got to look at those, and when you talk about mining, those commodities where you've got a comparative as well as a competitive advantage. So we'll stay invested in copper and gold, and in South Africa, we will continue investing in PGMs and huge investments in iron ore as well as manganese.
So you do think there is a substantial future for mining in South Africa?
Without a doubt. In South Africa and on the continent, but we've got shareholders all over the world, and part of our obligation is to have a geographic diversification. So African Rainbow Minerals has invested in a copper company in Canada, Search Copper, and that's going, it's going quite well. But we are competing, whether it's African Rainbow Minerals or whether it's Harmony, we are competing against some of the best companies in the world. And you've got to not just hold your own, but build a track record of success, of successively and consistently delivering competitive returns.
Can I talk about what I think is your other investment, South Africa, this country, right? Sorry, no one laughed there, I tried. Patrice, there has been quite a bit of good news for the country over the past few weeks, few months, 18 months since the GNU was formed. What is your view on where the country is right now? Because I think 2 years ago, many people wouldn't expect we'd be at where we are. How do you see it?
Well, South Africa has got enormous potential. We've got some of the best businesses, some of the best CEOs on the continent, and Elon Musk was born in South Africa, is that right?
Do we want to remember that? I don't know, maybe.
Yeah. But the point is, we've got some incredible people in the private sector. We've got world-class academic institutions. We've got two major challenges. And let me start with what I regard as a very important challenge is unemployment, our youth, the poor who have no jobs. Many of our people have challenges, even those who are employed cannot make ends meet. So we have to create a country, an economy, and the private sector is key. If you look at the most successful economies in the world, they've succeeded because the private sector has identified those countries as good places to invest, good policies, whether it's legislative or fiscal or tax. The governments welcome investment. So the private sector in this country is critically important. But as I said, side by side with the private sector, we've had problems with Eskom, big problems. We made big mistakes there in the past. Eskom was a world-class electricity utility, and we should never have had load shedding. It should never have happened.
Are you confident it's in the past, though, right now?
Well, without a doubt. And why I'm saying that is because part of the mistake we've done in the past is that we would employ people either because I don't know, the person who employs likes you, or you are my uncle, or my,
Are you referring to corruption?
Well, meritocracy.
Okay.
Meritocracy is non-negotiable.
Okay.
Corruption is non-negotiable. And of course, part of our challenges is crime. We can make billions of dollars on tourism. But, when I was at the FII in Saudi, a few weeks ago, I was in Silicon Valley because we spent a lot of time trying to learn and see where this AI, artificial intelligence technology, generative AI, and its impact not just on economies but countries and the future. So one of the biggest companies, the CEO said to me, "We want to come to South Africa and open a business." It's a company.
Okay.
And he said to me, "But is it safe? Because I need to bring some of my smartest people, and we want to make sure that their families are safe." So it's a reflection of the bad name and the bad reputation that we've built over many, many years. And we have to be more effective in making sure that our crime levels come down enormously. And the perception worldwide of South Africa as a good place for investment is attractive.
Would you say that's the biggest concern right now for the country is the perception? There's, of course, the elephant in the room. The U.S. president is not coming this week for his own allegations about the country. Is it a perception issue about South Africa? Is it an infrastructure issue? Where do you think the improvements start?
Well, there are two issues. Perception has an almost determinative influence on people's views. And what we have to do is consistently make sure, and it starts with our people, the business people, our families in South Africa, making sure that they feel that this is a safe country. And I've got many friends who say to me that, I went to Cape Town, it's one of the most beautiful cities in the world. I went to Johannesburg, I was told don't walk around, it's not safe, and it's very safe. And then you have criminals attacking going to a restaurant or kidnapping.
Bloomberg's Jennifer Sabasaja with Patrice Motsepe, chair and founder of African Rainbow Minerals at Bloomberg's Africa Business Summit. Of course, that conversation continuing in Johannesburg. There's a different conversation happening, of course, in a different part of the world at the Dubai Air Show. Our very own Guy Johnson is, it's of course, in full swing. And Emirates President Tim Clark speaking to him, saying he'll refrain from an order of Airbus's A350,000 aircraft for now. It's a blow to the French aerospace giant. Emirates had previously announced they were placing an order for 65 Boeing aircrafts valued at $38 billion. I want to bring you a little bit of that interview and what Tim Clark had to say, as I said, to our very own Guy Johnson. Take a listen.
We're moving at pace. We've ordered more aircraft here. We've got more aircraft coming in. The 350-900 is coming in. We've now got about 65 of those still to come in.
Yep.
The business is expanding. We're very high seat factors, and Dubai is really moving at pace anyway, so that's underpinning a lot of what's going on at the moment.
Front end of the plane, the premium traffic has been the big kind of underpinning of the market over the last few years.
Yeah.
How closely correlated do you think it is, though, to what's happening in the stock market, which is having a little wobble right now, crypto, which is having a little wobble right now?
It's very difficult. All this, the increasing demand of the premium cabins predated all of this. Okay, you could say that with quantitative easy going on at the pace it was, a lot of money was printed. Banks are pretty flush. People are making decisions because inflation is kicking in. They want to get the value for the money now. It could be something like that. Frankly, I'm not altogether sure. There are so many things going on in the global economy at the moment, both economically, politically, geopolitically. You can never be certain what is happening. What we do know, people are getting on our aeroplanes, not just ours, in the premium cabins. You see a lot of the US carriers now attending to premium products because they seem to have been behind the curve anyway, realizing that something has to be done there. So at the moment, it's very good. I can never say, Guy, that this is going to go on forever. The cyclical nature of the global economy, the kind of upheaval that we get for all sorts of strange reasons, whether it be natural, geopolitical or whatever, you just have to deal with it. But at the moment, the going is strong for our part of the world. I'm not going to say that it's going to be the same for the US. I know there's a bit of weakness on the North Atlantic at the moment, but we're not seeing that here.
Okay. You've ordered, you were just mentioning what you've ordered at the air show. You've ordered some Boeings. You haven't ordered some Airbus. Is there any Trump effect in there?
Absolutely.
Is he having an impact here?
No, none whatsoever. It didn't. It hasn't entered the thinking at all.
Right.
This is all about a plan that's been mapped for the next 15 or 16 years.
Yeah.
And looking at the assets that are available to us and the ones, obviously the 777-9 is an aircraft that we got really involved in its initial design We like what we see, and we want more of them. Now, the hiatus that Boeing's been going through for the last few years, I see a light at the end of the tunnel. Green shoots, all the usual cliches that go with this. Actually looks as though it's going to be. And we never had any doubt about what the aeroplane could do for us, particularly as the 380 was going to be going out at the end of the next decade anyway. So buying those aeroplanes was all about what the business needed, rather than anybody telling.
There's no politics.
No policy. The shareholder of the government of Dubai doesn't get involved in anything like that. They just say you must do what is best for the airline. Don't worry about anything else.
So you are different to other carriers in this region who appear to have made orders as a result of.
Okay, look, you know, these things ebb and flow. But as far as Emirates is concerned, we're purists. We follow our model. It's an organic model. And we're very, very focused on what we need to do and what the KPIs are telling us about how we're doing, how well we're doing. We don't really get people telling us, do this, go there, buy that.
That was Emirates Airline President Tim Clark and Bloomberg's Guy Johnson there speaking alongside the Dubai Air Show. I do want to bring you some breaking news. We had some unscheduled data released by the BLS posted on the Department of Labor website about jobless claims for the week of October 18th. Now, this is roughly data that was delayed from a month ago, showing that jobless claims stood at 232K for the week ending October 18th. Now, I want to remind everybody, I've been able to do some digging in this time, and that was roughly in line with economists' estimates off the back of state-level jobless claims. But remember, those state-level jobless claims that we have been getting during the shutdown have been non-seasonally adjusted. So there is a lot of math that goes into them to seasonally adjust them. But it does look like Wall Street has been treating these numbers with the same measure that the BLS does. So broadly in line jobless claims for the week ending October 18th. Kriti, I find this astounding that the Bureau of Labor Statistics is releasing data unscheduled onto its website. Now, we do have quite a large backlog of data. The weekly jobless claims figures, yes, they are important, but perhaps not necessarily giving us a good glimpse when it comes to the BLS's organization. We do want to see a proper schedule from the BLS on how they plan to release this backlog of data. It includes things like retail sales, PCE, import and export prices. These things are really key for the Fed. The market is still waiting for a schedule on how they intend to release this backlog, and hopefully it will get done before that December 10th Fed meeting. We started this morning getting an update on jobless claims, which, as I mentioned, tracks roughly in line with economists' estimates from that week based on the state level wide data.
It's fascinating, though, that one, this would come at this timing, to your point, but also on looking at the market reaction, we're not seeing it shake anything, even just the idea that it came during U.S. hours. I will say, though, since the data has come out, it feels like futures have come off their lows in the States, at least. So maybe there is a little bit of a reaction function there. The fact that it is in line with the estimates is a positive.
Yeah, maybe some comfort that the economist's view on the labor market is tying up broadly in line with the BLS official data, but a lot more to come. We are still waiting on a full schedule for them. Hopefully we'll get that sometime soon. And obviously what they intend to do with the October CPI release, which has gone mostly uncollected during the government shutdown.
Yeah, I think it's really fascinating as well. The idea basically that if you are flying blind, which is the major concern here, that the Fed is basically have to go fly blind, that at least some of the decision making is in line with the estimates that they did have. So there is a bit of comfort in that. In the meantime, we should check on these broader markets, though, because the sell-off does continue here in Europe. You are still seeing red on the screen across the board. This is a catch-up trade to what you saw in the United States yesterday. There's also a catch-up trade to what you were seeing in Asia. I want to bring you a couple of movers, though, that have been moving to the upside. ICG is one of them. It is your biggest index contributor to the upside. This, of course, a major firm right here in the UK. It looks like Amundi is going to be taking a stake in ICG as part of its new strategic plan to the tune of 10%. You did see shares rise by 8% after the partnership. It looks like they're also putting out numbers in terms of their first half profit. Those beat estimates as well. So those shares have been rallying off the back of that double upside.
And we also have talked about the defense trade. We've gotten an update from the Rheinmetall. This is the German defense company. Shares are in the green off the back of this update, around 3%, that they're targeting around 50 billion euros in sales by 2030. So maybe a long-term plan from them is giving some comfort to the market. The CEO saying he expects major investments to be done in 2027, and that they also have bought some shares in Autorion. another a defense company as well. So an update from the CEO giving a bit of shine to Rheinmetall shares this morning. I do also want to mention the one stock that is keeping the healthcare sector in the green, the only sector in the green across Europe this morning, and that is Roche. Shares up 6.6%. And this is on the back of a phase 3 trial when it comes to a breast cancer drug that they've been developing. So an early breast cancer drug is showing an edge in a key study in this these phase 3 trial results that keeping Roche shares higher this morning by nearly to the tune of 7% and keeping the entire healthcare sector in the green so far this morning.
It's fascinating. Those are some of the upside stocks, but we should mention they are few and far between. I think we hit the 3 big movers there because broadly you are still seeing pain in this market. It is red across the screen. I just want to get a quick check on some of these moves. Taking a look at 1.2% declines in the CAC 40. I have to say it's not as bad perhaps as we had started off the future session with, where we did see the DAX at one point indicated almost 1.5% and higher. So the fact that you are seeing the market come off of its lows is helpful even just 44 minutes into today's session. That being said, if you look at the futures picture in the States, it's a little bit different. S&P futures only down 0.2%. They have been pairing those losses since that data came out unexpectedly. You look across the board, though, you aren't seeing much cross-asset pickup from there, and I think that is going to be really crucial. When you look at the Nasdaq futures picture as well, that is where a lot of that pain is concentrated. So if you're worried about valuations, if you're worried about Bitcoin, if you're worried about tech jitters, that's really where it's going to show up. To me, I think it's still interesting, though, that you did see some of the Asian markets drop 2-3%. And that level of pain, that margin of pain, hasn't shown up in Europe just yet.
Yeah, at least when it comes to the big catalyst of the week, those NVIDIA earnings, those stock market bulls out there really do want to see the equity market find a firmer footing in case of an upset from NVIDIA. We're not necessarily finding that yet. The S&P 500 index yesterday dipped below its 50-day moving average. I should say dipped back below after just a week and a half above. So again, the equity market momentum does appear to be on a back foot, but let's see if we find some stabilization before those key NVIDIA results on Wednesday after the bell.
There's the NVIDIA story. There's the data print as well. I wonder how much of the jobless claims right now are some sort of harbinger for what we're going to get on Thursday. In the meantime, we've been giving you live coverage of Bloomberg's Africa Business Summit. We continue then with the key theme of unlocking Africa's investment potential. I want to get to an exclusive conversation between Daniel Pinto, JPMorgan Vice Chairman, and our very own Deputy Editor-in-Chief, Reto Gregory. Take a listen.
About Africa. So we have presence in Sub-Saharan Africa in 5 places, including now a new office in Kenya and Ivory Coast. We are upgrading our license in Nigeria. We have presence in Johannesburg and Cape Town here. We cover around 350 clients, both sovereign enterprises and private sector. So I think that this may be the time. I like what we are seeing in this country and in other countries in the region. I think that the redirection of the supply chain may be beneficial for this continent. So we will continue prudently, but invest. These are economies that South Africa is turning around, but also other economies are growing faster. So I think that there is a role for a company like us gradually and prudently increase our presence and our coverage in the region.
As you mentioned, I mean, Standard & Poor's just upgraded South Africa. Do you see further upgrades coming?
Well, it all will depend. I think that this government have done very good things in terms of the reforms on the energy and power sector, the opening of the transportation system and reform on that, the water reform that is coming. So hopefully all these turn the dynamics of growth and move South Africa to a level of growth that is more in line with the potential of 3%, 4%, 5% rather than a 1%. And I know that tariffs have been a bit of a headwind, but overall, after 10 years of the economy really stagnate, really having even having negative productivity. So the country looks to have turned the corner, and the potential is there.
some complaints in parts of the market that Africa still pays a prejudice premium when the countries issue sovereign bonds. I mean, I think Africa Finance Corp, the Development Bank, estimates that the continent spends as much as $75 billion a year on extra borrowing costs. Where do you stand in that debate?
Well, so markets are markets, and markets are relatively efficient at pricing the risk. So if, unfortunately, when you look at the dynamics in the continent, that it may improve, but at the moment, so that spread may be justified. So I think that over time, as the region improves, if the governance improves, the corruption hopefully goes down, there are structural reforms, all these things take place, so probably spreads will tighten, and that will be in line with better growth and better future for the region. But at the moment, it is what it is.
In terms of sectors, I mean, which sectors look interesting to you? Is it energy? Is it infrastructure, fintech, consumer? Where would you put your money?
Well, all of the above. Clearly, energy is transforming and requires a lot of capital to continue to do so. Infrastructure, transport is another, ports, airports, all those areas need investment, and it will create opportunity. Clearly, this continent has roughly 1.5 billion people, growing very, very fast. So the consumer industry should be a thriving industry for the continent. So all across, hopefully all this potential gets gradually materialized, and the size of the business that we do goes more in line with the size of the continent, because at the moment it's relatively small, but growing.
We put out a story the other day highlighting that Africa needs to create 1 billion jobs by the end of the century to fulfill its potential. What do governments have to do, and what are they not doing at the moment? What are companies doing or not doing to actually deliver on that?
Well, it's about what we have talked about. So this country, 40+% unemployment, big informal economy, 60% youth unemployment. So therefore, that is kind of the base for higher level of crimes and all that. So as you continue reforming these countries, so then the creation of jobs will be necessary, and they will happen. The size of the informal economy will be smaller as labor laws and other reforms take place. So likewise, you do all that, so everything improves. But they have to really do it in order for that to happen. You cannot continue with these numbers, 60s and 40s in unemployment and things like that. So I think that the government is doing all the right things in this country, and hopefully that continues and get deeper, so then you have a better situation for the people in the country.
Relations between Washington and Africa aren't at the best at the moment. You have accusations of genocide here. You have the Trump administration complaining about Nigeria not doing enough for Christians. Do you think this is sort of a short-term blip that's going to normalize at some point, or is there something fundamentally at risk in the current sort of frosty environment?
I think that all the situation with tariffs and relation between the US and many countries or regions around the world, at some point is going to stabilize. Tariffs will be set at a certain level, trade agreements will be in place, so therefore it's likely to improve rather than deteriorate, in my view.
You followed, obviously, and run businesses in emerging markets for a very long time. I'd like to zoom out a little bit and look beyond Africa. What's the state of emerging markets overall?
Well, I think that the fundamentals are good. These countries are growing, lower interest rates are helpful, the weaker dollar, some way or the other, helps too. Clearly, when you look at markets, emerging markets underperform for many, many years. This year is probably the best performing, including this country, that the equity market has gone up 40%, and in dollar terms, around 50 or more. So I think that they are doing fine, and including hopefully my country.
You took my next question.
Okay.
You grew up in Argentina. Obviously, there was a little bit of a wobble in the markets the other day. But generally, do you think Milei is on the right track?
So when he came to power, so the country was heading to a really meltdown, hyperinflation, all these type of bad things. And Argentina, from being probably the fifth or sixth biggest nation in the world after the Second World War, it's been deteriorating for the good part of 80 to 100 years. So he, on the economic front, he did all the right things. So cut the deficit, lower inflation, with a lot of pain from the population, but hopefully creating the base for growth. Now, he has done very well in the midterm election, but he doesn't have majority. So the challenge from here is more than the economic front, is the political front. Can he create the right alliances to do the structural reforms that they are needed for the country to grow faster, which is essentially labor reform, tax reform. If that happens, I think that there is a lot of potential, a lot of investment wanted to come to Argentina, particularly in mining and energy, agricultural sector, so agro-industry. So I think that the potential is there. And if this model is successful, then you could see the possibilities of the rest of the region moving in a different place, in a better place. Clearly, he has aligned himself with the United States, and hopefully the rest of the region does it too. Because if you think about the tension between China and the United States, so it should be very beneficial for Latin America, for Mexico and the rest of the country. So hopefully that happens.
When you look beyond 25 and into 2026, you seem to be quite optimistic. I mean, Jamie Dimon mentioned cockroaches the other day, which was sort of a quote that went viral. Do you see cockroaches around here?
I think the comment was taken a bit out of context, in my view. So it may be other cases of fraud, maybe. We don't know. Possible. Clearly, in the auto financing sector, subprime financing, with used car prices after the COVID crisis being so high, if you are lending to low incomes, you're going to have some issues. And in these cases, they are some related to fraud. What we are not seeing is a deterioration between what we were expecting.
That was Daniel Pinto, the JPMorgan Vice Chairman, and Rito Grigori, Bloomberg's Deputy Editor-in-Chief there, speaking on the sidelines of the Bloomberg Africa Summit. We'll be keeping you up to date with coverage from that summit throughout the morning. You can catch all of the conversations on your terminal using the function LIVE Go. Kriti?
Yeah, fascinating day to have those conversations. We're also seeing a market sell-off on the books this morning, but some that have pared back. There's some geopolitical news out there as well. We should mention that Donald Trump is looking to host Crown Prince Mohammed bin Salman from Saudi Arabia at the White House today. Coming up in the next hour, I will be speaking with former U.S. Vice President Mike Pence. That conversation coming up on The Pulse. We'll talk about international policy. We'll talk about domestic policy, maybe a little bit about how he views the future of the United States on the global stage. That conversation at 9:30 a.m. UK. That does it for the opening trade. The Pulse is up next. This is Bloomberg.